Are we on the verge of another global financial crisis? Maybe not. But we do look at some troubling data out of the commercial real estate sector and some other macro trends that paint a pretty bad looking picture. What can we learn from a famous American investor about the effects of debt and the realities of whether you will be wiped out or paid out in the event of economic collapse? Welcome to Bitcoin Daily. I'm Dante Cook, head of Swan Business. The COVID downturn had many impacts, but one thing that many people didn't foresee was that Suning, the Chinese owner of historic European soccer firm Inter Milan, would need a $275 million firm just in order to keep operations afloat. And you know who was going to lend that to them? Oaktree, the famous distressed debt firm out of the United States, and they offered them some pretty great terms. A 12% interest rate. Needless to say, the club defaulted on their loan, and Oaktree took control of the club. What most people don't realize is that when an asset goes under, there's typically a pecking order of who gets paid first, who gets paid second, who gets paid third. Many people tend to think that they would be in that first group of people that would get paid if stuff hits the fan. I'm here to tell you, that's not likely. If you go back and you look at the history of how people like Howard Marks or Oaktree have made money through the years, it's through distressed debt investing or taking over companies by buying their bonds or their debt and therefore having the first rights of preference for when things hit the fan. Howard Marks became famous because Warren Buffett said he's one of the very few people that when he writes a memo, he drops everything he's doing and he goes and reads it. Well, in his latest memo, Howard Marks gets into the impacts of debt. Here's what he had to say. And this specifically talks about what he thinks about when evaluating assets. The amount of borrowed money or leverage that is prudent to use is purely a function of the riskiness and volatility of the assets it's used to produce. The more stable the assets, the more leverage it's safe to use. The riskier the assets, less leverage. It's that simple. One of the main reasons for the problem today at financial institutions is that they underestimate the risk inherent in assets such as home mortgages and, as a result, bought too much mortgage-backed paper with too much borrowed money. In this memo, he was talking about the 2008 financial crisis, obviously. But I think this same mantra applies to not only financial institutions, but individuals today. There are many people that think certain asset classes or certain types of investments are risk-free when they have tons of risk. Let's take a look at a few investors that are beginning to realize all of the inherent riskiness in the system. And you know what people thought that they were making a safe investment when it actually was a risky investment? People who bought bonds in 1740 Broadway in New York Street, a large commercial building that had forever value claimed by lots of people. The AAA rated bonds actually only paid out 74% of their total value, meaning that 26% of people who probably thought that they would get paid and were making a safe investment were not paid out. This is the first time that a highly rated bond like this has not been paid out since the great financial crisis. Which leads me to an interesting thought experiment. If you were to invest in a large financial institution in the United States that made some risky loans and investments into other people and things that it shouldn't have, and as a result, it blows up and goes belly up, do you think that you would be one of the people that gets wiped out? Or, like the executives at these sorts of firms in 2008, would be people who were paid out? Or let's look at some entitlements as an example. Let's say that you're under 55 years old, and when the Social Security and Medicare and veteran benefits and all of these entitlements are no longer there, do you think you're going to be one of the people that gets wiped out or paid out? I think our parents are going to get paid out first. Or how about I flip this in another way? Do you think if the United States government defaulted on their debt and you're one of the people receiving Social Security, Medicare, veteran benefits, or some other benefit, that the government would be the ones getting wiped out and wouldn't pay themselves or politicians, government contractors, but you would be the one that would get paid out? That's unlikely. You would get wiped out and the government would continue functioning as it does currently. Or let's look at another example. Let's not even make this personal. Let's look at the after action report from the Bank Term Funding Program crisis of last March, where there was a run on 22 banks that had 10% or more of their assets drained in less than a day. The most interesting thing about the report, it talks about all of the different mechanisms and things that had to be implemented in order to avoid a full financial collapse. But of the 22 banks that were bailed out with $164 billion worth of funds through the Bank Term Funding Program, none of them were the large banks. And as you can see, and what we already predicted on this show, when the next crisis comes, regional banks will not be the ones that will be bailed out. They will be the ones that will be wiped out. And so, there's always a preference stack when it comes to getting wiped out, unless you own Bitcoin. Bitcoin is the only asset without counterparty risk. It's the only asset where if you self-custody it, there is no layers of who gets paid first, second, and third. You own the asset class. In most situations, and I'm guessing for most people that watch this show, if you're an average American and an asset or company that you invest in gets wiped out, you're probably not going to be the people that get paid out. And so Bitcoin is realistically the only asset class that is outside of that system. And the crazy thing is that we're still being told that there are assets like US government debt or treasuries that are risk-free. But how can you say that these assets are risk-free when interest payments on our debt are now larger than defense spending for this year? As my friend Greg Foss says, Bitcoin is a credit default swap or portfolio insurance in case the existing system collapses. You can read more about his research paper and the tool that we built at the Nakamoto portfolio by clicking the link in the show notes. If a company gets wiped out, if the Fed gets wiped out, if banks get wiped out, no problem. You own Bitcoin in self-custody. And through a platform like Swan, you can take self-custody in just a few clicks. We have free automated withdrawals. Oh, and by the way, we also have no fees on the next $10,000 worth of Bitcoin purchases that you make through the app or the web application. And you get the added benefit of Bitcoin actually making things cheaper when you price in inflation. Check out this cool chart from our friend Joe Consorti that shows the CPI denominated in Bitcoin. Life gets cheaper the more that you save in Bitcoin, and more expensive the more that you save in fiat. And with that, we're signing off for the day. One last final thing. I'll be away on vacation next week with the family and the kiddos in North Carolina. And subbing in will be the one and only Hurley, the guy behind the camera that does all the editing and all the cool stuff that you see in all of these videos. And so Hurley's like my twin, like another one from the Prestige that will do anything it takes to keep this show going while I'm out. And with that, you guys have a good weekend, and I'll see you guys after next week. This is Dante Cook with Swan.com. Happy stacking.